Good morning. It's Friday, the 20th of December, and this is Govindraj, Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital, the top stories and themes. The stock markets fall again on hawkish US interest rate stance. The rupee crosses 85 per US dollar now. It's time to brace. Consumer product companies are hiking prices sharply. The United States is considering banning router maker TP-Link, which also has a significant share in the Indian market. An important goods and services tax meeting coming up might see some rates being reduced. So, what will go up?
This is the Core Report with Govindraj Ethiraj.
It's a bad week for the markets. The stock markets did fall on Thursday on the fact that US Federal Reserve has indicated it will cut interest rates only twice next year as opposed to the 4 times expected by the markets, and thus taking a hawkish stance in anticipation of an inflationary environment there. Now, this obviously means that capital would find it more lucrative to stay on in the United States, including in bonds and the like, rather than go halfway around the world into emerging markets like India, or at least not as much as could have happened otherwise. All this, of course, might change a little bit in the new year as investors revisit their investment themes, the prospects of returns, and where they might find them, or rather in which markets. India is unlikely to have that blowout 2024 again, as we've been seeing, but it should definitely be better than investing in treasuries, or so we feel. The bigger story in some ways is the fact that Indian markets are swinging so wildly and mostly down this week thanks to the US Federal Reserve moves or the anticipation of them, which would suggest that domestic factors, including the strong flows, are not at this point able to counterbalance the outflows. Once again, this could change into the new year, but that's not been the case so far. The benchmark equity indices, the Sensex and the Nifty, were down sharply on Thursday, tracking the decline on Wall Street following the US Federal Reserve Chairman Jerome Powell's hawkish commentary. If you hadn't noticed, the Dow Jones Industrial Average had crashed by 1,100 points to its 10th straight loss on Wednesday, though futures had bounced back a little bit on Thursday morning. And back in Mumbai, the 30 stock Sensex fell 964 points to close at 79,218, and the NSE Nifty 50 was down 247 points to close at 23,951. The broader markets suffered similarly. The Nifty Mid-Cap 100 and the Nifty Small-Cap 100 were lowered, though not as much, by about 0.3 and 0.5% respectively. So Indian indices have lost over 3% each this week, and foreign investors sold stock worth a net 8,000 crore rupees, roughly, or about 941 million up to Wednesday, according to Reuters. Financials and IT stocks were the big sectoral decliners, falling 1.2 to 1.3% so far. Indian IT firms, as you know, are particularly sensitive to US interest rates as they earn a significant chunk of their revenue from North America. And the rupee has a bad day too. The Indian rupee sailed past the 85 per dollar mark on Thursday, hitting a fresh all-time low as the Federal Reserve's scaling back of its rate cut projections to 2025 hit currencies across the board, particularly in Asia. Central banks across emerging markets were scrambling to defend their already weak currencies. The Korean won dropped to its weakest level in 15 years, while the Indonesian rupiah hit a 4-month low, according to Reuters. And back home, the rupee hit a low of 85 rupees 8 paise against the US dollar before closing at 85 rupees 7 paise. Apparently, the Reserve Bank of India's dollar-selling intervention helped the rupee do better than most of its Asian peers, which declined as much as 1.2%, according to Reuters. The dollar index has now dipped below the 108 handle in Asia trading after rising to an over 2-year high earlier in the day, says Reuters, which also points out that US bond yields have extended gains, with the 10-year Treasury yield touching a peak of 4.54%, the highest since May. FMCG companies to hike prices. So inflation is catching up, finally, and companies, particularly consumer-facing, are quite evidently unable to hold on to their higher costs anymore. And the time to start passing it on is starting now. How consumers will respond is something, of course, that will be the story of the next quarter. So, fast-moving consumer good companies like Hindustan Unilever, Dabur, Godrej Consumer, Tata Consumer, Parle Products, Marico, Nestle, and Adani Wilmar are all hiking prices to offset higher commodity costs and increased customs duties, according to the Economic Times, which quotes executives at companies and FMCG distributors. The newspaper said that from tea and edible oil to soap and skin cream will be all 5 to 20% more expensive, also marking the biggest price hike in 12 months. One driving factor is edible oil, whose price rise we've been discussing on the core report, particularly after import duties were raised. Low edible oil prices, by the way, were also, or rather, helping keep food inflation down, at least relatively. The ET says that companies' production costs have gone up thanks to that 22% increase in import duty on edible oil this September and up to 40% in the year 2024. In 23, that's last year, the cost of key commodities such as sugar, wheat flour, and coffee had also increased, says the Economic Times, quoting a Parle product spokesperson saying that they were increasing prices across their brands. According to the Parle products person, Parle, by the way, makes brands like Hide and Seek and Fab Biscuits. They're seeing such a price increase after a whole year, but they were hopeful that it would not impact demand, which was already under pressure. The Adani Bangladesh face-off continues. Bangladesh's interim government has accused energy supplier Adani Power of breaching a multi-billion-dollar agreement by withholding tax benefits that a power plant central to that deal received from New Delhi, according to documents seen and quoted by Reuters. So the history is like this. In 2017, Adani signed an agreement with Bangladesh to provide power from its coal-fired plant in eastern India. Dhaka has now said it hopes to renegotiate the deal, which was awarded by then Prime Minister Sheikh Hasina without a tender process. And the belief is that this costs Bangladesh far more than its other coal-powered deals. Now, Dhaka has been behind on payments to Adani Power since supply started in July 23 and owes several $100 million for energy that's already been supplied and consumed. Meanwhile, the Adani Group has announced a new version of its Hum Karke Dikhate Hain advertising campaign as it tries to revive its image, which has taken a beating from a damning indictment in November by US authorities in an alleged bribery case. The company said that this campaign builds on the success of its previous edition and moves beyond the conventional corporate strategy of emphasizing statistics and figures to focus on inspiring human interest stories. The group said that these narratives showcase the profound positive impact of Adani's infrastructure projects on the lives of millions of Indians. And going back to that indictment, the charges relate to allegations of securities fraud, wire fraud, and violations of the SEC guidelines. Goods and services tax, something will go down, but what's going to go up? Reduction of goods and services tax on health and life insurance policies will be part of the Goods and Service Tax Council's scheduled meeting on December 21st. It has been widely reported. The group of ministers on GST, which is headed by Bihar Deputy Chief Minister Samrat Chaudhary, has submitted its report to the GST Council, which will meet in its 55th meeting. Now, the question, of course, is what will go up? Rumored to include everything from sin goods like cigarettes to apparel, leading in turn to howls of protest from the respective industries. In this case, the Clothing Manufacturers Association of India, who we spoke to, which has warned of massive job losses if goods and services tax was increased to 18% in the 1,500 to 15,000 rupee segment and 28% beyond that. There are other fallouts as well, and we'll come to that. To get a sense on how the year has been so far for overall GST collections and how India was poised and positioned ahead of the meeting tomorrow, I reached out to Krishen, Arora, Indirect Tax National Leader and partner at tax consulting firm Grant Thornton, Bharat, and began by asking him to give us that overview first.
So if we just talk about the collection trends right from 2017 when it all started and government had clearly identified GST to be one of the key revenue drivers, as it taxes all consumption of goods and services, right? So alongside the economic growth and the India's vision to become Atmanirbhar, a 7 trillion USD economy by 2030, a Viksit Bharat by 2047, which is a 30 trillion economy, I think the growth of GST was inevitable. We started from about 7.2 lakh crores in 2017-18. It's almost up by 300%. If you look at the current FY 23-24 data, is about 20.18 lakh crores. I think the last couple of months and what we saw in April 24, I think it was a bumper time because it is a closure of financial year, closure of commitments in terms of booking and putting all the expenses, etc. So 2.10 lakh crore was the highest we saw, which was almost a 12.4 crore jump of year-on-year growth. But if you look at the revenue growth and the collections from then to now, I think April 24 to October 24 is about 12.75 trillion, which is almost 10%, 9.5% increasing year-on-year. This has been consistently growing. So I think what we really see is a 20.14 lakh crore growth is almost an 11% increase in what is expected out of this. And that's what has been the trend. And if you look at states also, across many states like Kerala, Maharashtra, Karnataka, Gujarat, Tamil Nadu, Haryana. There are dozens of states which have got, a very high growth, which is above 20%, around 17%. Some of the states were at 15%, but there are states which have not grown because the consumption patterns are obviously different across states. So states like J&K, Sikkim were very low on growth, and some of the other states were even lower. So I think from the perspective of growth, the economy is obviously steady. There is headline improvement, obviously, in domestic transactions. There is significant variation which will continue to happen across states. But as we see it, I think on a year on year, I think the growth is going to be this. Plus, what you really see from here, I think, is economic resilience. And despite economic challenges, global challenges, our domestic variations, disparity, the consistent growth in collection is actually indicator of resilience in the economy.
Krishen, what's changing within that? So, one of the things is that if, let's say, if this was a race of sorts, though it's not a race in that sense, let's say a few states have charged ahead in because that they were always traditionally ahead in terms of collections. So they've stayed ahead, Maharashtra, Gujarat, Andhra, Karnataka, and so on. So has anything changed within in the last few years even as this economy has got formalized and obviously GST reflects that?
So I think typically, if you look at the way states are actually poised to look at investment, even from a perspective of attracting investment, states are competing with each other. I think one of the factors of opening up states and building that infrastructure from tier one to tier two to tier three, I think everybody's catching up. And wherever the game of investment is growing, and those are the states which will ultimately tend to gain from that perspective of building the right infrastructure, I would say. The second part is obviously the tier 2 and the tier 3 cities are now growing in terms of revenues also because of the consumption patterns. Consumers have also realized post-COVID that this is the time when we will want to make the maximum out of it. I think people are actually realizing that opportunities of job and employment are also increasing in tier 2 cities with growth of GCCs, and we always keep hearing news of central of excellences opening, the back office services opening in India. I think with the kind of growth which is happening in terms of the way India is being looked at, it is inevitable that each of these states will have its own pattern, but it will still steadily grow. Some of the states will still lack it because of the infrastructure. They will probably have some of the indicators in terms of the climatic conditions that will come in, where the consumption patterns will always be lesser in terms of the growth pattern. But other than that, with the economic growth, I think every state will catch up.
Okay, I'll come back to states in a second. So one of the things that we are obviously talking about right now is the prospect, or we are discussing the prospect of increasing GST rates. So there has been discussion about a 35% sin tax, discussion of increasing GST on apparel to 18% up to 15,000 rupees, and then 28% beyond that. So what does all of that reflect, and what is the likelihood that we will see higher rates? And I guess to that I can peg the question of how are you seeing 2025?
Sure. I think I'll talk about the rate rejig first, and that's been on the agenda. I think the upcoming GST Council meeting, which is poised on 21st December in Jaisalmer, is going to be action-packed. There's lots to address. The top of the agenda is actually GST rate rationalization. You're aware that the group of ministers was interested with the responsibility to kind of look at the rate structure. Was it a possibility that we go down in terms of the number of rates, because not only causes the multiplicity causes variation in compliances, but also the position which people take in terms of which bucket they fall under, etc. I think that is what was looked at. So the multi-tier rate structure was always something which was planned that will become smaller as the GST stabilizes in India. That's what happened. And I think almost initially a 150 item list was actually proposed by the GOM, which was to be discussed in the council. But they have obviously identified hiking some of the rates, while others, there's also reduction. So the specific ones which you just mentioned, I think I'll pick up some of them. The rationale between on the health and life insurance, I think, is on exemption and reduction. So there is obviously a case for that because the senior citizens are the ones who are actually the most largest beneficiary of it. So reducing a rate on individual health policies is on the cards, and that's likely to happen to 5% from the 18% rate. Also exempting the life insurance for senior citizens is something which is higher on the cards. On luxury goods, see, whenever there's a reduction of GST on something, there has to be a cross-revenue projection also, which the government looks at. So they always look at the luxury segment or the same segment to, compensate for it. And that's the reason why they identified, some of the affordability items which are in the upper market or the luxury market for that matter. And that's why the premium segment was touched, that they will not have bit of that kind of pinch which a normal consumer would feel. That's why that slab of 15,000 plus in shoes, the 25,000 plus MRP of wristwatches, where the rate of tax was looked at from 18% to 28%. I think that was one thing. Other products also were covered. There was a reduction which was looked at ready-made garments, bringing something from rates from 12% to 5%. This also again MRP based, and the more affordable garments where they lower the rate from that perspective. Similar to that is packaged drinking water and exercise notebooks, where existing rate is 18% and 12, bringing it down to 12% and 5% respectively. Sin goods, I think, has always been the criteria that sin goods are not the kind of goods where the focus of the economy or the market should be. It is something which always is adverse to encouraging consumption. That's why tobacco and aerated products are always part of that. And that's the reason why pan masala, aerated drinks, tobacco items which are currently at 28%, is where, actually the initial proposition was 40% jump, which is the maximum rate which can be imposed on GST, which can be proposed at least under the law today, which is where the 35% rate is actually being looked at. But it's also a far-reaching consequence also from that perspective, because this is going to be an impact not only on the sector, also the ecosystem. Looking at the overall consumption pattern, what will happen? The working capital requirement will change. The technology intervention will have to change. A lot of things will have to change for this to get accepted. But if the government is going from that perspective of looking at sin goods differently, I think nothing will come in the way of that.
So, give me an example when you were referring to, let's say, a 35% rate, and that in turn affecting, let's say, cash flows, because obviously you deposit GST. So, what is the industry that could, or what are the industries that could get affected the most with a sudden jump in rates?
Any industry like tobacco, basically the market, sin goods market, driven by tobacco, aerated beverages, is going to get, obviously aerated beverages means some of the FMCG companies are going to get impacted. So these companies ultimately today have planned an outflow of tax, which is at 28%. There is obviously, input tax credit, wherever it is available. But many of these products are outside GST also, because they attract other taxes also, the local taxes and the excise as well. So when they look at the overall tax structure, not only the margin will get hit if they don't pass it to the end customer, and whenever it passes to the end customer, it's always a pinch, right? There could be a change in the consumption, demand, etc., which will happen. But because they are sin goods, possibility of it getting stabilized in some time from now might happen. But that's something which has to be still looked at. But if you look at the way the working capital will change, obviously the GST has to be paid upfront, right? Monthly GST has to be paid. So your money paid to the recovery of that money from the distributors and the chain, which is going to take time. So there has to be additional working capital impact because of that also, because you have to fund your outflow of GST. So those are the things which will have to be kept in mind for these sectors, and that's why they have to be given time to prepare for this, is something which also the industry asks.
Right. Last question. So, as you look at 2025, so what are the areas you are hoping for, let's say, more structural reform? One is rates. Rates, of course, is always a critical part of it. But are there any other areas that you're looking at where you feel there could be more structural reform intervention?
I think there are a couple of things on the collection. See, if you have to boost the GST collections, then what is being said is that getting to that 2 lakh crore average number, monthly number in the next fiscal, if you have to do that, then I think there will be more focus on enhancing the compliance, digitization, tax administration from audits and assessment, because there are a lot of notices that there are a lot of demands being raised where ultimately the money gets stuck, either for the taxpayer or for the government department. So also, getting the administration on the tax dispute resolution with GST appellate tribunals have not been set up till now, soon to set up. So one moment these machinery starts functioning, I think there are a couple of things which are on the agenda to kind of look at, and faster remediation on one side and better compliance and tax administration on the other side is something which the government is definitely focusing on. Other than that, I think amnesty schemes also are the ones which help in boosting revenues and also reduce the longitudinal litigations which are going on. So something on that front is also something which is, the deadline is 30th June 2025. Hopefully, government gains a lot out of that, as well as the taxpayers. So standardization of processes, administrative compliances, and digitization, plus better administration in terms of giving the judicial system a push, is something which is on the cards. Other than that, I would say, including more sectors into GST, like petroleum products, etc., will also help in, making the economy more and more inclusive, and GST rates will get stabilized across the board. And that's when the rate rationalization can come in. When you actually start including more sectors is where the GST revenues start to increase at one side, and sectors also tend to gain, because the impact on the burden of GST on the revenue neutral rate becomes standard for everyone. That's the whole idea of GST becoming a one nation, one tax, and one GST rate, which is a dream.
Okay. Right. On that note, Krishen, thank you so much for joining me.
Thank you so much. Pleasure.
TP-Link's tentacles. US authorities are investigating whether a Chinese company whose popular home internet routers have been linked to cyber attacks poses a national security risk and are considering banning the devices, according to the Wall Street Journal. The router manufacturer TP-Link, which was established in China, has roughly 65% of the US market for routers for homes and small businesses and is also the top choice on Amazon and powers internet communications for the Defense Department and other federal government agencies. I don't have the exact India number, but TP-Link is quite popular in India as well and sells all kinds of routers, large and small. One report I came across said TP-Link has a roughly 24% share of India's wireless local area network, or WLAN, which should reflect the enterprise or business side of the market and surely large in value. Cisco is close in share of the router market and has been ahead in the past. The Wall Street Journal says investigators at the Commerce, Defense and Justice Departments have opened their own probes into the company, and authorities could ban the sale of TP-Link routers in the US next year, according to people familiar with the matter. An analysis from Microsoft published in October found that a Chinese hacking entity maintains a large network of compromised network devices, mostly comprising thousands of TP-Link routers, and it's been used by numerous Chinese actors to launch cyber attacks. These actors have gone after Western targets, including think tanks, government organizations, non-government organizations, and Defense Department suppliers, according to the WSJ. TP-Link routers are routinely shipped to customers with security flaws, which the company often fails to address, according to people familiar with the matter, says the Wall Street Journal. Adding that while routers often have bugs regardless of their manufacturer, TP-Link doesn't engage with security researchers concerned about them. TP-Link has resoundingly denied all these allegations and says it hopes to work with the government to find resolution. And before we go, some feedback. ESS 1226 says, what a pleasant surprise to hear about the legacy of Zakir Hussain here in the core report was very unexpected. Well, it was unexpected to me too, and also because the person I spoke to, VG Jairam, who's a live entertainment veteran in Mumbai and India for that matter, was much closer to Zakir Hussain than I would have guessed and came up with all those beautiful anecdotes from their time together. So thanks for noticing. Neil Mail says, thank you for hosting conversations that matter. Thank you, Neil. We do try our best and we hope we can continue to and will always deliver. And Mozo199 says, this channel will continue to grow. Hang in there. The content is awesome. Absolutely, we will, Mozo. And it's words like this that make a big difference to us. And we hope that you will continue to be listening to us and continue to be giving us your wonderful feedback. Thank you and bye-bye. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.